Okay, time now for John Zechner's Top Picks. Top pick on this day, Meta Platforms, ticker symbol META on the NASDAQ.
Yeah, we haven't talked a lot about these big tech companies that I call on NVIDIA earlier, but I mean, when you saw what happened with obviously the Meta earnings last week, but then Alphabet and Microsoft coming out. I mean, these hyperscalers, the data center players. I mean, there's still massive spending there, and a migration to AI is sort of in the early stages, but first they're laying the infrastructure for that. But then I look at Meta and Alphabet in particular have benefited because of the their targeted online advertising, and Meta has done an incredibly job of migrating over the years, and they are a dominant player in the mobile and online advertising, and it's very targeted, and AI is going to make this even more targeted. The productivity for the advertisers by using these platforms is increasing dramatically over time, and that's why they're going to Meta and to others like that for this advertising. When you look at it, when Facebook went public in 2013, basically all of their advertising was off of the desktop, and they really didn't have a lot of advertising. They've done an amazing migration over to mobile devices. So I think they've done very well in migrating onto these different platforms. Now, the stock got hammered in 2022, down 70% on this Reality Labs, and I agree. I mean, to me, that still sort of seems dumb. I'm not really getting it. I don't see anybody walking around with the giant headsets on as their way of sort of experiencing the web or anything like that. But I think, Meta is way more than Reality Labs. I mean, they still got, obviously, all of their applications. And I think, obviously, what's going on with TikTok, they've been a beneficiary of that, with the change of ownership, because they've been able to monetize Reels a little bit better. So you look at it, all of that for a 20 multiple? I mean, a little over a 20 multiple. They expect about $20 in earnings this year, and trading at $440, so 22 multiple. I thought, you know what, that's not particularly expensive for a growth stock positioned exactly right in a hyperscaling business.
Okay. Number two, John referenced he was going to talk about Canada's telco sector. Here it is, Rogers Communications, ticker symbol RCI.B.
Yeah, and the earnings came out last week, and they were in line with expectations, and they would have probably beaten expectations. The only place they missed was on the media side, which means the Blue Jays are costing them more money than they should. So that's really, in the grand scheme of things, that's not what's going to make Rogers go up and down. I look at the wireless businesses. Yeah, you got 4 players now instead of 3, but that's basically it. Wireless continues to grow, usage continues to grow, penetration continues to grow. Everybody's streaming. These guys have done their capital expenditures, onto the network. You showed how robust the networks were in the downturn, trading about a little over 6 times operating cash flow, 10% free cash flow yield. I think these things are out of favor because I mentioned with BCE, the worries people have about, the additional competition in wireless, and the fact that maybe subscriber growth was driven by huge levels of immigration in new customers. When they come in, you need a cell phone, of course, and that maybe, with less immigration, you may get less of that. Well, I don't know. I still see continued growth. You get the roaming activity is back up and running again because people are traveling more. And like I say, these guys have done their capex. They're generating free cash flow. More of that will ultimately go towards dividend payment. And at the same time, they're consolidating the Shaw assets, and they've gotten the run rate of cost savings. They're about a year ahead of schedule on that one. So all of that, yet these stocks have been in the penalty box for 2 years now. And I think, to me, that's opportunity.
Okay. And number 3 on this day, Pfizer, ticker symbol PFE on the New York Stock Exchange.
Yeah, there's an overriding theme here that I got, that I'm looking at the market, not at, the hot things that are going to have great moves, but what I think can rise, but also has some downside protection. I look at Pfizer. I mean, this stock is down 60% from the peak, trading about 10 times forward earnings, got a 6% dividend yield. And the smart thing they did is the disappointment why the stock's down so much is obviously they made so much money off the COVID vaccines, and then suddenly COVID's gone, the demand for the vaccines dropped even more than expected. Paxlovid hasn't caught on as much as maybe the expectations had been. They took all of that windfall cash and reinvested it in new growth areas, which I think are going to start to generate earnings growth down the road. a lot of new cancer therapies, obviously in some of the diabetic drugs as well. And they've even got some, potential in the weight loss like Ozempic, and they've got some potential competitors in that area which they actually get to it as well. I'm not sure. So I look at all of this, a low valuation. I thought that's what I want in the stock right now. Not that much cyclical sensitivity, high dividend yield, low valuation, and some potential for growth and out of favor. And this thing is definitely out of favor.
First idea, British American Tobacco, BTI.
Yeah, in this particular case, this is really a total return story. We've got interest rates are probably going to end up getting lowered a little bit here. It has a sustainable dividend. The segment is very out of favour, despite the fact that it's transitioning to heat not burn, non-combustible. There's a 2 billion share buyback, and if you hold it for 10 years and nothing happens, you'll get 100% of your money back.
That's a dividend.
And that's assuming no growth. But typically companies that have very cash flow generative tend to buy back stock, tend to buy other investments, tend to grow. So this is really a large pushback against the ESG fraternity and a recovery to the mean here. So the stock should be substantially more expensive and larger than it is. But for now, I'll take the 10% dividend yield.
A yield of 10%, yeah. Yeah, and the tobacco industry says they are determinedly, in a determined way, pushing towards non-burnable products.
Well, definitely that, and that product transition is well underway. And the balance sheet's fine. So really what you're talking about is a sin stock that's is reforming itself, and the ESG fraternity, from the investing point of view, doesn't want anything to do with it. So capital flows are very low, and the stock declines as a result. But very attractive dividend.
Enbridge is your next idea.
Similar story. It's a total return story. It's a mission-critical North American energy backbone. So what you've effectively got is a company that, for example, in the US provides 20% of natural gas exposure consumed in the US. Obviously, huge market share here in Canada. Mid-term growth 7 to 9%, and you've got an attractive dividend as well. So again, in a mean revision environment with a lower interest rate, you're getting well compensated for holding, and we will see some upside here. So again, we own this. We've owned it a long period of time. In fact, I think this is the single longest name we've owned in the firm. We've owned it something like 28 years. So it's been very, very good for us long term.
Yeah, we move about 30% of the crude oil produced in North America. We transport nearly 20% of the nat gas consumed in the States.
Yeah.
And we operate North America's biggest natural gas utility by volume. So they're a significant player.
Significant player, yeah.
And then finally, your final idea for us is a Givaudan.
Givaudan, yeah.
Givaudan.
So Givaudan is a Swiss-based stock. Now I like Swiss companies because they trade at a premium in terms of currency from Canadian dollars. So if they increase the dividend, the magnification on currency is quite large. But Givaudan is the global leader in fragrances and flavors. For example, the fragrance in the Procter & Gamble Tide product, or the flavor in the Klondike bars, and the longevity of these relationships is very large because you very seldom change the vanilla profile of an ice cream bar and things like that. So they have a tuck-on acquisition program that works quite nicely. It's low risk, and the 10-year dividend growth in Canadian dollars for the dividend is north of 6%. So you're getting well compensated for owning a company. Periodically it goes on sale, and it serves a global best-of-breed roster of clients. And so you really don't have a lot of business risk either. So great company. We own it.
And it's a serial dividend grower. You say 6% plus a year over the past decade?
Yeah, I think it was 6.2 in Canadian dollars. So one of the things I would sort of flag is when you look at it in Swiss francs, it doesn't look like it's done too much. But if you start looking in Canadian dollars, you look at a total return, you look at the dividends, then you look at the share performance from a buy point of view, and then anchor it. 6% over 10 years is on a per annum basis is actually a substantial return.
Top pick number one, the chip maker, Micron Technology, or chip or memory maker anyway. Carry on, Cole, sorry.
Yeah, it's kind of a combination, I guess, but kind of, in a similar space to the NVIDIAs and AMDs and some of those other companies of the world. And yeah, just for the way that we see things moving forward here, I think this AI, is just in its infancy, and it's going to be a major driver of, profitability and for companies. And basically, we're looking at some different companies that are kind of like a utility to that sector. And so some of these chip makers are certainly that. And with a name like Micron, it's come down like the overall market. So, a little bit more volatile, but still from like both a fundamental and a technical perspective, I think that there's a lot of upside, and I see the price target of 132. I think it could probably go as high as 150. So I think there's some pretty good upside, and you're buying it at a relatively good level here with the recent pullback. So just something that I think with where we're at in this phase of the market, I think these types of names will perform well.
And your next idea is Meta Platforms. There are concerns over their heavy capital expenditures.
Yeah, so the stock had a nice run up. Basically, earnings again. Some stocks get priced to perfection, and this was probably one. And so, because the analyst call didn't maybe quite go as planned with some of these expenditures, the stock came down fairly significantly. And to me, it's just a good opportunity to buy one of the better names. They've turned around their advertising. They're using AI to be able to generate significantly more revenue in that segment. And then, on top of everything else that they've got going on. So I had been looking for an entry point on Meta for a while, and with it coming down, I think 12 or 15% there. I think that that entry point has showed itself, and I think it will not only get to all-time highs, which I think was like 520 or 530, something like that. But I could see a scenario where it starts to move significantly higher than that as well. So proof will be in the pudding. They've still gotta have good earnings and be careful with some of the spending, but you also need to spend money to make money in some of these industries, and I have a feeling they're going to do it well and make it pay off.
Okay, and then as promised, iShares Semiconductor ETF SOXX looks decent right now, you think?
Yeah, so this is more of a broad-based play. Again, with sometimes with more cyclical type of companies, you get specific stock risk and then you get sector risk. So when you own some of these individual names, if the stock misses earnings, right now you're seeing a lot of names go down 10 or 15%. So sometimes it's nice to have a little bit of diversity where you like a specific area, but you maybe don't want to pick individual names. And when you own stocks, you're going to get, like AMD and NVIDIA and TSMC and Micron and Intel. So you get some, exposure to a lot of these companies that you probably would want to own anyway, but you just kind of get it wrapped in a nice little package. And actually in Canada, there's one too called CHIPS. It's the Horizon Semiconductor ETF. CHPS. So it's pretty similar to stocks. So if you didn't want to, own on the US side, then there is a Canadian equivalent to it as well.
And is this a buy and hold, or would you see it more as a cyclical play?
I would buy and hold it for like the next year. We'll kind of see where we are in the market cycle after that. But again, my viewpoint is that growth is going to outperform. And so this is kind of one of the leaders in like the growth segment. And that's why I would be, geared towards sticking with this one a little while for sure.
Earlier in the show, we had somebody ask, well, what did Brooke think about what's attractive from a seasonal perspective now? Well, here we are at Top Picks, and that's what we're going to get at. What do you like today?
Well, it's the theme overall is defensive, because we have seen that the rotation out of the technology. Despite what's happening today, we saw that going to the cyclicals, and now it's starting to go to the defensive sectors. So the healthcare sector is actually a good defensive sector overall. It's been beaten up quite a bit over the last little while, really over the last couple of years, as everybody's been pushing into to technology. I think it's at a level now that represents good value. We've seen that pullback take place, and I think the healthcare sector is starting to gain a little bit of an appeal. We could see it actually do quite well over the next few months.
The second is utilities, which to your point has done well already in the past month. And I wonder if there's like a bit of an AI play to it as well, because they have to increase the power that they're supplying.
Well, if you take a look at from utilities perspective, we've got the whole build out of the grid. We've got Bitcoin demanding higher energy, and also too AI is going to have a big factor in this. People don't realize how big this is. And so we've seen the utility sector actually perform quite well. And we were talking earlier on about breakouts from double bottoms. And look what took place here. This is a bottom here, this is a bottom, and here's that peak in between. We saw that breakout take place. So that's a positive technical pattern for the utility sector. And as interest rates come down, there should be some more leverage in this sector as well. Investors have already said we like this sector. I think they'll still continue to be attracted to this sector at this time.
Well, since you mentioned interest rates, your third pick is a bond pick, the 7 to 10 year Treasury bond ETF. What do you like about that particular area of the market?
Well, I think that's, if we're going to look at the whole curve, I mean, the benefit from the Fed cutting is really going to be at the 2-year level. They don't control the end so much of the curve, like the 20-year part of the curve, but the middle part of the curve, they do have a little bit of impact. So I think that them cutting rates is going to help the 10-year go lower, as well as we're seeing some economic slowdown right now. And so if we take a look here, if we do see an economic slowdown take place, I think we will see a breakout take place above what we saw in 2023 here for U.S. government bonds. And this one here is Global X, and I work for Global X, as full disclosure. We're actually just starting to get into that position. If you take a look at, so it's in Canadian dollars, right? In this case, this one's not hedged. So you're benefiting from a currency move if we see the US dollar strengthen. And I think we're going to see that take place as Canada moves closer and closer to an interest rate cut, as well as the US actually starting to cut as well. So I think it's going to be it could be a double benefit.